I'm Russ Mould, AJ Bell's Investment Director, and in this edition of Breaking the Mould, I'm going to look at two sets of results and a piece of macroeconomic news which are more than capable of causing a big fuss in the week ahead. Now, in order, they are Tuesday the 6th of October, a trading statement from high street snack specialist Greggs. On Wednesday the 7th of October, interims from struggling supermarket giant Tesco. And on Thursday the 8th of October, if that weren't enough for you to digest, we have the latest decision from the Bank of England's Monetary Policy Committee on UK interest rates. So let's take those by date and start by tucking into Greggs, whose shares, as the chart behind me shows, have enjoyed a stunning run since Roger Whiteside took over as chief executive in February 2013. Before he took over, Greggs had suffered a few spills as it dished out profit warnings, was unwillingly embroiled in an argument over VAT on food sold above ambient temperature, remember the pasty tax row, and also faced questions over its expansion into the wholesale market. Profits fell in the year to 2013, and a fabulous run of consecutive annual dividend increases came to an end when the payout for that year was left unchanged. Whiteside reviewed the firm's strategy and focused on the food-to-go market for retail customers with an emphasis on relocating and refurbishing high street shops rather than adding new ones, whilst also tightening up the supply chain, IT and cost management. Now the results speak for themselves as the share price shows, and also new ranges, refitted shops and cafes delivered 5.9% like-for-like sales growth and a 51% jump in adjusted pre-tax profit at the first half stage. The interim dividend grew and the board also authorised a 20p per share special dividend for good measure. Whiteside said trading was slightly ahead of expectations too, so let's see what this Q3 update brings. The benchmark will be that like-for-like sales growth number as well as progress on the estate. At the halfway stage, Greggs had refitted 135 sites, opened 44 new ones and shut 30. Now for the full year, the analyst consensus is pre-tax profit of 70 million quid, up from 50 million last year. The other question then to ask is whether 21 times earnings for this year and 19 times for next may be a bit rich on the valuation front, which may be why the shares have recently paused for a breather. Now if Greggs has recently been firmly on the way up, Tesco's a turnaround story that's yet to bear fruit, if you'll pardon the expression, under the guidance of boss Dave Lewis, who took the helm in September last year. As the chart behind us shows, it's been a tough first 12 months for the ex-Unilever man, and Tesco shares are back hovering near their 12-month lows, despite confirmation of a plan to sell its Korean operation for more than 4 billion quid and use the cash to pay down debt. June's trading statement wasn't so bad, with like-for-like sales down just 1.3% in the 13 weeks to the end of May. But with volumes at 1.4%, it was clear that pricing pressure created by rivals like Aldi and Lidl hadn't gone away. This next graphic shows group total like-for-likes and then the figure for just the UK and Ireland. As you can see, they're improving, there's some improved momentum, so like-for-like sales will be one area of focus at the interims, and the mix between volume and price come to that when the interims again are published on the 7th of October. Now Tesco's is focusing on operating profit as its key benchmark, and that was £916 million a year ago for a return on sales of 3% at the interim stage. The firm now also splits out UK, International and Tesco Bank, so we can see how the three arms are performing. And don't forget, if you want to, you can actually invest in Tesco Personal Finance via the order book for retail bonds, and income hunters in particular might like to do a little bit of research here. That leaves us with just the Bank of England and the Monetary Policy Committee's latest decision on Thursday the 8th. Now after the US Federal Reserve's decision not to raise rates in mid-September, I don't think anybody expects the UK equivalent to make a move, and therefore it's likely going to leave rates unchanged at their 0.5% record low and leave quantitative easing untouched at £375 billion. As we can see from the chart, the base rate's not changed since March 2009, and the market doesn't expect to hike now until at least Q2 2016. So I guess the interest here will lie with the minutes from the meeting. Now they're now published on the same day rather than 2 weeks later. At the last two MPC meetings, 8 members voted against a rate rise and just 1 for. So it'll be interesting to see the scores on the doors this time. This final graphic shows the MPC's voting history. Bars above the line are votes for a rate hike, bars below for a rate cut since the last reduction in March 2009. And as you can see, Nobody's been pressing for a rate cut. There's been the odd outbreak of pressure for rate hikes. It's really, again, hard to see why there's going to be dramatic change last time. Let's see how the score compares to the 8-1 result from the last 2 meetings. So thank you for watching, and I look forward to seeing you next time.